All right, thank you, Steve. Thank you, Stell, Blake, Peter. I see you in here. So great to have you back, buddy. I'm going to make you the presenter. Look forward to our talks as I have through the years. Welcome back to F.A.C.E, Pete.
Right, so Dale, can you hear me?
Yeah, I can. I got you, buddy. How are you?
Pretty good, actually. Thanks. It's nice to talk to you again.
Yeah, you know, how many years do you think it's been, Peter? 3, 4, at least?
Yeah, well, who's counting? But yeah, something like that. I mean, yeah, I mean, time does fly.
You do enough counting with your charts. I count this, right?
Yeah, absolutely. No, it's been a few years now, but it's been great because you know, to be part of your organization has been really good to see what you're doing and updating so professionally. And I have to say, Dale, you're really up there, and I really appreciate you contacting me, because it's really great because we talk the same language, we see things in the same way. We also have a good history of the markets, which is fun to go back to in time and seeing, you know, what we discovered and what we've learned since. It's great experience. So thanks.
Oh, you're very welcome, Peter. And that was a great segue, because, you know, before we get to the charts here, I was interested in talking a little bit about what separates and distinguishes your work, you and your work, which is synonymous, from the multitudes of Elliott Wave practitioners. You know, there's many out there, and, you know, some are good and some aren't as good. And, you know, I can vouch for you being spot on so many times over the years. Is it the time that you put into your analysis, or is there any different twist that you use in your wave counts that most don't even know about or consider doing?
Well, I think there's a combination of things. First of all, it is certainly the amount of time you put in. I mean, I can see that, especially with some of my tutors, some of my pupils when I've taught Elliott Wave in the past. I mean, there's a clear distinction between those who want to put in the time and those that don't really. But I think also I have one tip for anybody that is doing Elliott Wave, and that is that go back to Elliott's original writings, especially in Nature's Law, which was published in 1946. You get a feeling that his work was incomplete, but he was getting into this point where he was looking at symmetry, dimension, geometrics. This is where Fibonacci overlays come in, of course. Everybody in the FX world knows about the use of Fibonacci stuff, but it goes a bit deeper. And if you start looking into what Elliott's initial works were about geometrical measurements and stuff like that, you then probably sort of start reading books about geometry, patterns in nature, all of these types of elements, and you begin to get a certain rhythm and idea of how markets are trying to evolve. One of the big setbacks for anybody trading Elliott or analyzing Elliott is the fact that also, without this idea and concept of geometry, symmetry in the patterns, you're really left with distortion on several times. You can be influenced by the news flows, or you can be influenced by some other exogenous event or sentiment situation, and you will distort those patterns. But if you work from this geometric principle idea, which Elliott was touching on the sides of when he was in his last years of working with this and developing his theory and refining it, you'll get to a point where you look at the patterns not from distortions anymore, but looking from the symmetry point of view. And therefore, when you start measuring the patterns and their amplitudes, you will see that there's a high frequency recurrence event where, for example, a zigzag where waves A and C are geometrically measuring the same more often than not, or there's a relationship between waves A and C through an extension type ratio approach, which I can show you. You know, for example, on this dollar index.
Okay. Yeah, let's go the buck here.
Yeah, you can see my charts, right? And
yes, got them.
I mean, if we just tick a box 38.61.8, and if we go up here to measure a zigzag completion, here's 5 waves up into last month's high, and we just extend a couple of ratios, you're going to get 2 upside targets. Now, the 38% target for wave C of a zigzag is predicated on the depth of wave B. It has to be at least 50%. If it's 38% or shorter, then we would naturally go up to the 61.8 area here. And the main reason for that is because we're trying to geometrically ensure that we're not seeing a distortion in the measurement between waves A and C. And you know, this is very important. There are of course always exceptions to a rule, no matter what you look at. But generally, if you keep, yeah, exactly. If you just keep to this concept of playing out the repetition of these patterns and these measurements, you will get great amount of hits. And when you do see a little bit of divergence or deviation, it really brings your focus and attention into it. And then you can start working with different degrees of trend at the same time, just to see how malleable that trend deviation is occurring. And invariably, you'll be able to pick up the slack later. So I come from a perspective on Elliott Wave where customer drives your product. And a lot of our clients, most of them are institutional clients, and they've, you know, I have people in my books for the last 25 years, and they're still with me. But they're very, you know, when you get to that point, you're driven by success and results. And if you make a mess of things and you don't get something right, you have to find the solution to why it went wrong. So there's a lot of introspection. There's a lot of feedback going back over a scenario. Why did you forecast it this way? Why did you forecast it that way? Would there be?
It might be a silly question, but do you actually journal those things?
Do I do those things?
You know, the things you do. You journal. You know, kind of like write down when a scenario didn't work out and what you didn't see, and that you look for next time, or you just remember it, you take a mental note?
No, I do both, actually.
Okay.
I do both.
All right.
Yeah, I actually make notes and say, well, why did that go wrong? What was different then? I found also,
I think that's a great, you know, that's a great point. You know, and I want to just emphasize it, Peter. You've been trading, you've been in these markets and doing this for how many years?
Well, look, I daren't say 40 years, but it has been. I don't know.
And Peter still writes things down and journals and goes over his work, reassesses. And so if someone who's been in the market for decades does it, it's probably a good idea for people that have been doing this for a few months, a few years, to be in the habit of having that discipline so that you learn from your mistakes. And I just wanted to make that point that, you know, a lot of us after many years, we just stop. And so that's also something that I think sets you apart, is your intensity for, you know, it's your bread and butter. You have to get things right.
Absolutely. And, you know, there's motivation to do that. Obviously, if you're working alone, and I know, you know, many people are sitting in their office or their desk, and they're trading currencies or whatever, it's very hard to keep up that incentive. You know, there've got to be some incentives to, you know, to produce. And I would just say, look, Eve, it doesn't matter whether you're doing Elliott Wave or any other methodology, as long as it works and makes you money, that's good. But if you know, invariably you have a bit of a clanger, which I mean, you know, you have, you know, one of those times when you're giving back all your hard-earned money because you're over-leveraged or you've got one particular, go back over that, have a good think, be retrospective, don't be afraid. I mean, it can be daunting to do that because you're facing a loss. Nobody likes to have a loss, and it feels bad, you feel sick. But these are things which, to be really efficient and to getting those results consistently over time, you really have to be afraid of your darkest soul, and you have to go into that and start examining what you were thinking at the time. And sometimes you forget, you know, if you're doing so many different things, or you've been distracted, you know, it's a good thing to note down why you went into a trade. In fact, I do that for my own trading. I always write down why did I want to do it at that particular moment, because invariably you sometimes go back and think, actually, I don't remember why now. I mean, you should know why every time, you know, but
Yeah.
sometimes your mind plays games, and
Yeah.
you don't want to face the truth, so you hide it from yourself. But if you write it down, well, you've got nowhere to go but to look at your own handwriting.
Great.
But anyway, yeah, it's an
Great
important
segue.
aspect.
Yeah. Okay. So we're looking at the dollar here, Peter, and I think as long as I've been talking to you, you've had negative bias, and you're answering my question here. I was going to ask you what you thought of this rally from 88.5 to the recent high at 550. If it was just another bear market rally, or there's more to it. And I could see from your count here that you're looking, depending upon, as you explained earlier, if it's a shallower correction, we could look for higher levels. A deeper correction, not as high. Am I reading your work correctly?
Yeah, absolutely. I mean, again, it's good to go back over things and see what happened. I actually had a very good introspection with my own work, because this chart I'm just putting up now was dated February 2nd, so it was pretty much at the lows. But I still thought there'd be one more twist down to 87.72 before we got this. Yeah. I mean, I was looking at this. I thought, well, look, we're missing a little fourth, and we need a little bit of a dink down to 87.72. Yeah. This was a 61.8 proportional ratio of the measurement of 1 to 3, and I felt pretty comfortable with that. I actually even spread it out time-wise a little bit, because I don't know if I got this. Yeah, I was showing a client this earlier. This is my my own composite cycle, which I've developed on a daily basis, that is. And for those of you who aren't familiar with cycle work, the idea on a composite cycle, at least, especially when you overlay it like this, is not to project where the amplitudes. This has got nothing to do with amplitude of price. I mean, if we're working with amplitude of price, we work with Elliott wave for pattern, and price terms amplitudes, we're working with fib price ratios, extensions, and so forth.
This is more like seasonal tendencies, or just the cycle of highs and lows, how they run.
Yes, I mean, this is not seasonal. This is basically a composite of about 5 or 6 different cycle intervals, which I've done manually. I've gone back and looked over and seen what regularities are involved, if there's any misdemeanors, but we've put them together in this software, and then it produces a composite. But it's basically timing. You can see the timings here. The low here was pretty good. Here was a bit late. The cycle was late, and it was late here actually, but it did complete the thrust that we saw in May. And that's interesting, because you'll often find here, look, here's the absolute high for the dollar index in January last year, but the cycle came later when the thrust developed, and that can often happen, and it's happened here. So I thought when we did originally a look at the dollar index, this was a bit of a consolidation. We get one more flick down, and then it would start to push up. We had this cycle really, starting to accelerate. So we knew the dollar was coming. This is going back to the February low,
right? And
we knew that some pretty big upswings would develop. And of course, this is the reality since. It had a slightly lower low here, but that was all that came through. It was a very short fifth wave, and I'm very interested in that, because
is that like they call that a truncated or a fifth wave failure?
Well, it's not a truncation. It would have to finish above that third wave low there, and it was. Okay. But it's very short. You see, Dale, that's pretty odd. And the same thing happened at the top here, actually. When this peak developed, this fifth wave was actually quite short. And this one was short on the downside, and I got a bit wise to that last month, because we're then counting 5 waves up here, and ordinarily what we would do at this point would be to extend waves 1 to 4 by 61.8, and that would have come up somewhere up here. But I suddenly realized this was pushing the expectation a bit too far, because ultimately this is only 5 waves. This is wave A of a zigzag, and if we're projecting wave C beyond such a point like that, It's going to go even way up here. It's not impossible, but you're just lessening the odds, the probability. So because these short fifth waves occurred up here and up here, I suddenly realized that we could have a short one in here. It was the only explanation, the only rational explanation for getting up to this 50% band, because if we measure fib price ratios and put retracements levels in here, look, come down here, you'll see the 50% marker come in.
Oh, yeah.
And I think that 50%.
And we were a little short of that with a double top, kind of made me suspicious of this recent high.
Yeah.
You know, that there was no stop, there was no cleansing of the high, the move prior. It was a perfect double top to the pip. So,
yeah, exactly. And it was nice. I mean, okay, I mean, it was pretty good to see that. I'm working with log scale charts. You probably might have got the exact, you know, on an arithmetic chart. That could happen sometimes. But
okay.
For me, that was pretty satisfying to see enough there. I thought, well, the fifth wave in this case is obviously has to be short, and that's where we got to. So, you know, when you look at it now, we're in a regression phase down here, and we have to, you know, obviously see. I think we're going to see some more dollar declines before this thing goes back up again.
Okay.
Yeah, I think that's the general concept, and it's the same for the euro inverted. You know, if you take a look at the euro,
right,
we're looking at sort of getting up to the 50% retracement area before.
Yeah, I mean, a lot of people are talking that would be like a head and shoulders top formation. That would be a right shoulder there.
This one, like this.
Yeah, yeah.
Yeah. So here's the neckline. Yeah. Well, I mean, yeah. So if this pops up here, you get the right shoulder, and then down she comes, isn't she?
Yeah. Yeah.
Yeah.
Okay.
Yeah. I mean, that's not bad. It's not bad. I mean, the thing is that with head and shoulders, of course, if you take that measurement and block it down, you'll get probably somewhere down like that.
Okay.
So it would work out pretty well, I guess. Yeah, that would be perfect.
Right. And that's the end of 2, and then we have the money wave coming. Sometime next year is when the dollar starts to fail again.
That's right. Yeah. Well, let's have a look at the euro in a bigger scenario. Where are we? Here we go.
Because you know, a lot of people are saying that, you know, we're going to challenge the lows from last year, the 103 lows, but that's not what you're seeing here. Just a big pullback, and look at that, 202.
Yeah, that's right.
Okay.
Well, we got some. Yeah, we got some pretty long-term data here, and we go back to the 1920s when the Reichsmark was basically worthless. So
you know, I had lunch with Jesse Livermore back then. We were talking markets.
I would love to join you.
And sorry, you know, I had to pick up the tab because he was a little early. But, anyway, so wow, I mean, you know, and this has been your view for as long as I've been talking to you, that there's going to be, you know, a rout of the dollar coming up.
Yeah. I mean, this hasn't changed for, I can't remember when. I mean, let me just to show you roughly what this looked like. Well, this is I just found an old chart from yesteryear. This guy, I don't know, this is dated in 1999, 2000, I think. And you can see that, you know, ABCX, ABC, and this was coming down in a zigzag. And this is ancient. And this is the X wave. We've come up in 80 cents. Actually, it's good also as a, you know, I keep all my charts, so I like to look through back to see what we've done, and that's another good way of introspection, you know, so that you can see whether you're fooling yourself or not.
Exactly.
But this hasn't changed really for a long time. This is the birth of the euro here. I never forget that because we had a really nice zigzag in there. You know, you can do this. Measure these numbers down here, but no, this is going up. This is going up a lot. I don't think we're going to go back to 103. Who's saying below 103 then? Anybody? Anybody else?
There's some people that are, you know, looking for it to take out 103.
Really?
Before there's another low.
Wow.
But, anyway, you know, that's what makes a market. I know that I recall a conversation with you, and it's pretty timely. I don't know if you prepared for it, but I remember talking to you. It may have been over Skype, or we were exchanging notes, and I remember you saying 75 in crude was going to be a sticky area, and we're there now. So I'm wondering what the potential scenarios are from a level that you called a long time ago, the $75 level, and what your thoughts are. Okay.
Yeah, absolutely. Well, I mean, one of the things which was really fantastic on oil going back to the low we saw in February 16 was the fact that, again, this is a really big effect, you know, because we're labeling this decline from the July 08 highs up here down here as a zigzag. So this is, you know, and this is again another very good point. You know, you can't do this work if you're not in log scale, by the way, and you've also got to make sure that your fib price ratios, your extension levels, are set to log. Now I got CPG. I'm using CPG, and I asked them to put this this in for me specifically, because if I untick this box for a minute, and I'm choosing 100%, okay, and this is a log scale chart, but you watch what happens if I take 100% of this and pull this up to the top here. You can't even see my 100%. Actually, I have to move it up like this. Where is it? Oh, where'd it go? Hold on. Let's do that again. Yeah, it's in there.
Yeah, so key point being log scale on your fib.
Oh, there it is. It slides down so low, I can't even see it. It's somewhere down. It's gone off the scale.
Like minus, we get paid to, it's minus 20. They pay us to fill up our car.
Yeah, exactly. Yeah, I'll put it. I'll put it into linear scale. Maybe that's better. You can see it comes down to here. Look, if you take that 100% value and subtract from there, you're getting into minus. Okay, so you can't do that. It's not workable. So what you've got to do, and I've got to remember to put this tick box back in, is just go down like this and subtract from there, and that's where the C wave should finish. This is all about proportionality, which I was talking about earlier. And you know, just because it happens, you shouldn't necessarily believe it. But basically, I'm just.
So 75 doesn't look as sticky. You're looking for 78, 90, 87, 90.
Yeah, well,
before
basically,
we have any kind of decent correction again. Yeah,
what we've got to do is, again, we've got to extend this initial swing up, which is primary wave A. Now, the orthodox top primary wave A is here. So we extend that by 61.8, and that produces this projection line, which is 78.90. But you'll notice that the B wave, the correction down, was actually what we call a running flat. It drops down wave A here. That's the low in August 16. Then it runs up 3 waves into February 17, then drops 5 down here. So sometimes what you can do is you can include the B wave of the correction to extend.
I remember you liking the crude in the low 40s. So that was a great call.
That's right. So during that time, that correction, that's right. Yeah. And then so you can see the next movement is up here, 87.90. If you include the B wave here. So we've got 2 upside targets, which are, you know, getting very interesting to see. Now, I don't know at the moment which of those 2 will eventually cause a major peak, whether it's going to stop at 78.90 or not. Now, I've got a couple of working hypotheses going on at the moment. One is in which this pulls back and then we get up to 87.90. But I have to admit that if we don't pull back immediately, and this trades up more immediately to 78.90, if you see that happening in the next weeks, so it trades up there immediately, and then suddenly it pulls back really hard, then we've got a reversal signature. And then we know that 78.90 of these 2 upside targets, let's go back to the other one, then the 78.90 will be enough.
Interesting. Okay.
And that means, you know, if we get price rejection there, then we're coming down in wave X to, you know, $55.
Okay. Still looking for 3,200 S&Ps. Nasdaq's made a new high. Russell's threatening again. You've been talking 3,200. I've also seen some corrective calls that you've made. Okay, so interesting.
Yeah, yeah. This is the daily chart from 2016. This is what I call the grand resynchronization lows, because back in February 16 we had, a sort of a year and a half correction. That was certainly the case in Europe, because most of the European markets were unfolding from a peak in 2015 into that 2016 low. But don't forget that that also occurred when emerging markets and commodities were forming a major low in early 2016, having had a 5-year decline from the 2011 peak. So we've got basically everything re-emerging, converging down there. I called it the grand resynchronization, and that was one of the clearest signals in my career that we should be buying commodities, emerging markets, S&P, whatnot. And
so
since then,
I just wanted, you're one of the first ones that I heard using the synchronized global recovery narrative with what's happening in China, like with the F.A.C.E, being very weak, breaking down. Is that narrative still true, that we're still in a synchronized global recovery, or is it starting to lose a piece here and there of participation?
Well, I think it's still basically very much in general growth intact. Yes, I mean the synchronization is aligned. I think you've got the Shanghai Composite, which has been taking a hit. We can look at that in a moment. But just before I leave this S&P, I just want to, this is an incorrect count. I've seen this on blogs and everywhere. It's completely, forget that. This is the S&P schematic, focusing on just this year. Sorry, the data's just loading. But if I give it a bit of a shove, it might encourage it for some reason to come through and be visible. But basically, what we've had this year, this is a remarkable pattern, which we recognized very early on in its scenario. And it's basically a zigzag decline from January's high.
Right.
But there's some really added, I mean, this is a very good tutorial for Elliott Wave, because there's a lot of different things going on here. Sorry, this is really not loading very efficiently, but it'll come into focus in a moment. Maybe what I'll show you is what we had back in April, because April was this low down here. And by the time we got into late April, we saw this 3-wave pattern, and we knew it should be 5 waves developing. So we immediately updated this as a diagonal, which it's been working perfectly since. If I show this chart, this is dated 19th of April.
Yeah.
And you can see the general wedge shape of the diagonal. It's 5 waves, 1, 2, 3, 4, 5, like this. But the tip-off was the fact that this was a zigzag.
Right.
27.17. And you can see we had a forecast right that time down to 25.90 around that area before it starts to pick up again. Well, have a look now. Here's the low, 25.94.
Right.
And here's the
Very
continuation of it since. It's picture perfect. And if we can get up to 28.28, that's going to be a very, very interesting thing. And then we're going to get this swoosh down.
Okay.
That's 12% drop.
And then the lift off again into the year end. But it looked like your highest numbers, even after this correction, have come down a bit. You didn't have 3,200. You had like 29.95 after this low. Was I reading it? Oh yeah, 29.94. The end.
Well, it could be a little bit higher. Yeah, it could be a little bit higher than that actually. This is a sort of, I'm working off.
Thinking we're good, and even like 4,200 until like the end of 2019, and then we started generational bear market, and that's the chart I'm talking about.
Yeah, this is the one you're referring to. This is now a lot of Elliott guys are talking about 1, 2, 3, 4, and a big terminal fifth here. This is not going to work. Why? Because if we take a look at the emerging markets and the commodity scenario, we're engaged in an inflation pop at the moment from the grand resynchronization lows. That's the second phase beginning here.
Right.
And those markets are very, very far from complete. Now, the commodity sector is undergoing some rotational corrective declines
That's a good segue, Peter, because I also remember from our last interview when gold was knocking on the door of a breakout at 1360. You said that, you would go with it in case it was, it was the beginning of something. But you said, I'm expecting a false breakout if it happens. And you had some, at the time, some downside targets that we're almost at in gold. Back then you were talking 1220 as a possibility. And so here we're looking for a pretty good break. You're looking for a retest of 2017.
That's right. Well, the reason I was suspicious, the reason I was suspicious that if it did break out above here, we should be very careful for these were the big numbers where I thought that if it did break out, it would hit there and then drop really hard back inside this range. That would have made this an expanding flat if it had traded up a little bit higher. I was pretty confident it would be a false breakout because I could see that this entire upswing from the December 2016 low, which is basically from this point here onwards, there was lots of overlap. This type of configuration is not consistent with a sustained break above the highs, a new bull market, in other words. It was consistent with a more complex correction where you would formulate a top up here and then it would pull all the way back inside the range. And we didn't get the breakout. I was hoping we would because I wanted to see if it would suck in a lot of the institutional fund managers, because at the beginning of the year, they were getting, at the beginning of the year, the institutional fund managers were all getting very excited about a more immediate sort of persistent inflationary expectations. And I thought, well, if they were also, BlackRock and a few of the big guys were making big noises about inflation picking up, and we saw from the CAT that the long positioning was getting very high. And I thought, well, if this does break out, I don't see that that's going to be conducive to a pronounced and sustained move up. And in fact, in a way, it didn't. It got defended here, and of course, you've seen it drop back since. And I think this means that we're going to have to wait until the end of the year, early next year, like in all the commodities, like copper and other things like that, and the emerging markets, before they get down like this, before we can go back in. But if anybody's listening and they've got disorientated with gold because it's done nothing for the last year and a half, don't be too disorientated, because when we do get down to these numbers, you're going to have some fantastic buying opportunities. And of course, again, we've got to fight our emotions down here. We'll probably feel as if you're probably going to
go to 980. You'll sit down there. You'll say, well, could trade under 1,000. You'll be hearing that. You're already hearing that.
Oh yeah, I wouldn't be surprised. I wouldn't be surprised. I remember when we got nearly down to here, people were talking about 800, weren't they, and things like that.
Yeah, there's still some 750 guys out there. Well, let them watch. Peter, another great interview, buddy. Excellent views. And why don't you take a minute or two to show your website and how people could reach you and subscribe and.
Okay, that'd be great. Thanks.
Peter, really think that Peter's someone that you guys should keep an eye on.
Well, thanks a lot. I really appreciate that, Dale. Well, if anybody's listening and they're interested in Elliott Wave and some of the forecasts that we can make, even if you're not into Elliott Wave per se and you're using other methods, you can always cross-reference what we're saying against your own and measure us up. We're quite used to being put under the microscope in terms of our forecasts, and we try very much to keep a very high degree of forecast to the way that the price action develops. And you can always visit us on wavetrack.com. If you do get that far, go to subscriptions, and you can see a very low cost subscription to the Elliott Wave Compass report, which is here. And it's $39 a month, and we publish twice a week, some really good reports, and that's one entry level that you can subscribe to us from. And if you're using Twitter, for example, our Twitter account, let me just put that across, is shown here, and Our handle is at @ElliotWave_WTI. And we've got a lot of stuff going on. In fact, here we are already.
Yeah.
Our interview today, which is great. And we do put a lot of educational stuff on this is extracts from our original material. I'm fortunate enough to have some of Elliot's original work, so we post those occasionally. And a very good feedback came through on what Elliot called a half moon pattern. And we've written up a lot of that stuff. And this is always accessible through our blog as well. So if you get to our blog, you can see full articles which reference from Twitter and so forth. So that's really how we operate, and we'd be love to see and hear from anyone.
Well, thank you so much, Peter, and good luck with England in the World Cup. All right, maybe they'll put you in the game so you could draw some waves and patterns for the team to follow.
I wish there was something I could. Yeah, I wish there was some trends there. I could map it out. The score would be fun.
Thank you so much, Peter. Good hunting. Appreciate all the insights and views. So I hope you have a great summer trading season, my trading warrior brother. Thanks for being with us today, bro.
Yeah, you're welcome, Dale, and we'll keep in touch. Thanks again to you.
Okay, everyone, that's our Turnaround Tuesday with Peter Goodburn. You know where to find him. There's his website, and it's ElliotWave_WTI on Twitter. Hope you guys enjoy the rest of the day. Let's see what's happening here before I say goodbye. Euro, still, I'd like to see you close over 1720. Okay, everyone, good hunting. See everyone tomorrow. Remember, don't just count your pips, count your blessings. Adios. Thanks again, Pete.